Don't be a drongo, Sheila. Stop at that rackers. G'day, my dear blokes. I'm Bruce from Straya. No wuckers. We'll fill this billabong in no time. Fair dinkum.
Hello, my name is Ksenia Cherne and I'm a professor at the Faculty of Economics and Tourism in Pula. In our previous meeting, we listed and defined the basic financial statements. Today, we focus on the first of them, the balance sheet of statement of financial position, as it has been called lately. As balance sheet is a basic financial statement that shows the balance of assets, liabilities, and capital or equity on a specific date, called the balance sheet date. The balance sheet could be prepared on a daily basis and would be different from the day before. The reason for this are the business events that result in changes in assets, liabilities, and capital or balance sheet categories. We will pass through the balance sheet in more detail with our friend Bobby.
When founding the limited liability company Movie and Bobby, I invested 100,000 euros, which is the company's capital or equity, its own source of financing. At the time of establishment, the balance sheet of the Movie and Bobby company consisted of assets comprising money in a bank account in the amount of 100,000 euros and capital in the same amount. The balance must always be balanced. This is the result of the logic of business according to which the assets must have appropriate sources of financing in the form of capital and liabilities. Now, let us remind ourselves what Ksenia told us about balance sheet categories. Assets represent all resources that are under the control of the company as a result of past events and the use of which will result in future economic benefits in the form of cash inflows. Capital represents the value that the owner has invested in the entrepreneurial venture, and it changes over time depending on whether the company is operating successfully or not. Liabilities represent the current duty or responsibility of the company to act or perform something in a certain way. In order to settle liabilities, an outflow of resources is expected. Shortly after founding the company, I bought a camera, a personal computer, and software with the money that I have initially invested. There were 30,000 euros left in my bank account. The company's balance sheet has now been changed. Indeed, the balance of money on the bank account has been reduced from 100,000 to 30,000 euros. The difference of 70,000 euros was invested in the purchase of a camera worth 30,000, a computer worth 20,000, and software, the price of which was also 20,000 euros. The structure of assets has changed, while the company's capital has remained unchanged. And now I have a new camera. Yay!
What will Bobby do with the camera, personal computer, and software? To begin with, he agreed to make a promotional video about Pula's castle, a fortress almost 400 years old, the small Roman theatre, and the underground corridors below.
Move!
Verdinken.
Let's take a look at what the balance sheet of Moving Bobby looked like at the end of its first business year. In the first year, Bobby's company generated 280,000 euros in revenues and 220,000 euros in expenses. The result of the business is the difference between revenues and expenses. In the first year, a positive business result was achieved. Profit in the amount of 60,000 euros, as the difference between revenues of 280,000 and expenses of 220,000 euros. Revenues and expenses represent accounting categories that show changes in assets and liabilities that affect the change in capital, except for changes caused by direct investment or the withdrawals by the owner of the company. Profit is recorded in the right-hand side of the balance sheet within the capital and liabilities. Together with invested capital, profit represents the company's proper source of financing. At the end of the first year, capital and liabilities were thus increased for profit in the amount of 60,000 euros, amounting to a total of 160,000 euros. Since the balance sheet must be balanced, assets have also increased by the same amount, in our example specifically money. At the end of the period, the cash balance is 90,000, while the value of total assets is 160,000 euros and it is equal to total liabilities.
The balance sheet has an appropriate form and structure that allows stakeholders to obtain the first information on liquidity. Liquidity is the ability of the entrepreneur to regularly settle overdue liabilities. To enable such a balance sheet to be presented, assets and liabilities are classified according to certain criteria. Thus, according to the time and functional criteria, assets are divided into long-term and short-term of current assets. Long-term assets are those assets that will be used by the entrepreneur for a period longer than 1 year from the balance sheet date, that is, during several business cycles. It consists of intangible, tangible or fixed assets, financial assets, and receivables. The camera, computer, and software are an example of a Moving Bobby long-term assets because the company planned to use it to produce video material for several years. Current assets are assets that are expected to be sold or consumed in the ordinary course of business, is primarily held for trading, and will change their appearance within 1 year from the balance sheet date, that is, during one business cycle. It consists of inventories, receivables, financial assets, and cash. The money in the bank account of Moving Bobby is an example of short-term assets. Namely, it continuously circulates during time periods shorter than a year, serving as a means of settling liabilities and acquisitions of the necessary resources. Liabilities are divided according to the maturity criterion into long-term and short-term or current liabilities. Long-term liabilities are those liabilities that fall due for settlement in a period longer than 1 year from the balance sheet date. If Moving Bobby plans to buy a video production studio, it is likely that it will have to get a long-term loan with a repayment period of 10 years. This will be its long-term liability. Short-term liabilities are those obligations that are expected to be settled in the ordinary course of business and are due to be settled within 12 months of the balance sheet date. In the case of Moving Bobby, it would repay the loan in equal monthly annuities. The part of the loan that due to payment in a period shorter than 1 year would represent its short-term liability.
In conclusion, let's summarize the topic elaborated today. The balance sheet consists of assets that include long-term and short-term assets. Total assets must be balanced with capital and liabilities. Liabilities consist of long-term and short-term liabilities.
The balance sheet is a starting point in getting familiar to the entrepreneur's business, and therefore it is necessary to pay special attention to its analysis. I wish you pleasant studying until the next meeting.
No wuckers.